I mean, certainly there's been action in the Treasury market, but at the same time, from an equity perspective, obviously we've hit new highs. And so I think our argument that one should not get thrown off one's investment thesis because of a backup in rates has indeed been accurate. And I think, look, the biggest bad call or wrong call that the sell side had as consensus at the beginning of 2021 was that the 10-year U.S. Treasury bond would end 2021 yielding 1.2%. I pointed that out and said it was by far the biggest miss of all the various sell side pieces, and I stand by that. And look, we've gone a long way towards remedying that, because now virtually every single one of those firms, those big banks, have 2% at the end of 2021 or something around there. So one point is that we've come a long way in fixing what was a mistaken perspective by the market. So that's always a good thing. Today, the Treasury market has backed up for 7 weeks in a row. There's almost never been 8 weeks in a row. Secondly, I'd point out that the long end of the U.S. Treasury market is the most oversold it's been in almost 30 years. And third, I'd point out that the hedged yields, so yields for a German or a Japanese or Chinese investor, when hedged back into their local currency, now given the backup in rates, the 10-year yield is the most appealing to those buyers that it's been in several years. So a lot of things are lining up to suggest that we've probably seen the bulk of the move, at least in the near term. And obviously we have an important 7-year auction later on this week, I think for $60 billion odd in 7-year U.S. Treasury bonds. And remember, it was a bad auction, or what was perceived to be a bad 7-year auction a couple of weeks ago, which really set all this off. And so, let's pay attention to the auction and see the results. I mean, to me, the supply-demand dynamic in the Treasury market is going to be a factor going forward. And so I'm with the Fed watching for disorderly conditions, or for tightening financial conditions, or for blowups in the credit space. That's where we'll see some of the things that will concern the Fed. And so far, notwithstanding a very poor start to the year for investment grade debt, down about 6% year to date for LQD, the investment grade ETF, there's no sign of poor credit action or widening spreads or busted issues. In fact, issuance continues to be very, very robust in the credit space. And so for me, I'm in the camp that says we're in pretty good shape. We've adjusted and dealt with one of the big offsides calls, 1.2 10-year Treasury at the end of 2021. Never made any sense if you really thought the economy was going to grow at 6%. So now we're at 2%. I think that's much more in the line of reason. And I'll just point out, Roberto, that there's no real relationship historically between strong growth and higher inflation. And that is that the U.S. is moving away from 40 years of the thesis that government is bad and should be as small as possible. Really beginning in the Reagan years with his famous 9 words, I'm from the government and I'm here to help, which he called the 9 most terrifying words in the English language. Okay, most terrifying words. I'm from the government and I'm here to help. And now we are in the Trump administration was a natural end point, because remember, the Trump administration's main objective was the complete deconstruction of the administrative state. So these were not just words. This was policy and philosophy, and ended up leaving us with COVID in the response of the Trump administration to the COVID pandemic, which was subpar at best. And so now we're in an environment that's completely different. We have massive challenges. We need to get a handle on COVID, which I think we're doing in the US. We need to deal with climate, which is, again, an existential issue. We need to deal with inequality. So there are huge issues in the United States. At the same time as there is very cheap money, interest rates, whether at 0.95 or 1.75, still in real terms negative, and very low in nominal terms, suggesting that lots of investment could make the return necessary to pay the debt and add value. And we also have a Biden administration that is staffed with ex-Obama people. Remember that in the United States, the vast majority of infrastructure projects are state and local projects, not federal. Therefore, they take time, they roll out differently, and therefore this is something that's gonna, not like the rescue plan where the money hits very quickly. The infrastructure plan will roll out over time, will hopefully have a major climate component to it. I believe it will. And will be something that I believe the administration is going to present in the next 4 to 6 weeks. And that should be something that, again, we can all look towards as a way to kind of cement a stronger U.S. economy that deals with climate. And so when you're worried about inflation and you're worried about sustained inflation, you have to kind of argue about the fiscal cliff as that money rolls off and infrastructure takes time. You also have to argue, and I forgot to mention this earlier, about the velocity of money, right? There's one thing when there's a lot of money around. It's another thing when that money is coursing through the system, moving rapidly and prices changing rapidly. Velocity of money in the US and in most of the developed economies is virtually dead. There's virtually no velocity of money. And so that's another thing that you can look at. And when you talk to someone who's really bearish on inflation, worried about inflation really taking off, ask them about the velocity of money, because at this point, there is none. We talked about how there are three big divergences at the moment. There's the divergence between the US vaccination process and the European vaccination process. Very wide, right? US is now administering 2.5 million to 3 million shots a day. We're going to be at herd immunity most likely by early June. Europe, as we all know, is struggling to kind of get out of the gate in terms of its own vaccination process. Several important countries having to go back into lockdown, all sorts of arguments about, you know, who owes what to whom and who has the vaccines, etc. So that's one divergence. I happen to think it's about as wide today as it's going to be. And so that divergence I expect to narrow. And remember, markets are forward looking. So the market is arguably pricing in a narrowing of that divergence. The second divergence is between the growth profile of the US and that of Europe. US is probably going to grow about 5 to 6% in Q1. Europe is likely to have negative growth in Q1. But again, remember, we don't invest on growth. We invest on earnings. And earnings in Europe in Q4 were way better than expected. Had the best breadth of earnings beats in a decade. So that's something to keep in mind when you're struggling to understand why Europe, equity-wise, is doing well and actually outperforming the United States. The third divergence is within Europe, and it's between the manufacturing, which has been very robust, and the service sector, which has been very, very weak given the lockdowns. I think that too is at its wides. So where this is going to be expressed, I think, is mostly in the currency, because U.S. exceptionalism, when the U.S. is doing better than everybody else, that's bullish for the dollar. And we've seen the dollar make a little bit of a move up, but very muted, very limited. Global reflation is bearish for the dollar. And so I think that's the tug of war between the dollar. The market senses that Europe will get its act together on vaccinations, that will lead to a lifting of the lockdowns. It will likely mean that the service sector expansion in Europe might be more robust than elsewhere, because you'll be coming out of true lockdowns. We haven't been in lockdown here in the U.S. in months and months, and everybody's super excited about the big liftoff. So to me, I told John this morning, and I'll share with your audience, what I see as a triple play for Europe and for value versus growth. I put it in the context of the shift from growth to value, because Europe represents value.